Hello, and welcome to the second episode of the Wallfacer Labs podcast. Today's guest is Marcus Leanos. Marcus is the co-founder of MJL Capital, a multi-strategy digital asset hedge fund, and Adapt3r Digital, a trusted bridge between real-world asset origination and decentralized finance. Marcus, welcome to the show.
Ryan, thanks for having me. Really excited to see you guys do a podcast. I've always thought you had a perfect voice for radio.
Thank you. Not the face for it, though. So for listeners who might not be familiar with you and MJL, could we maybe just start with a brief introduction of both you and the firm?
Yeah, absolutely. So as you said, my name is Marcus Leanos. I'm the founder of MJL Capital. I can just start on my own personal background. Before I founded MJL Capital in 2021, I was with a firm called EJF Capital, just outside of Washington, D.C. What I did there, generally speaking, was investing in community and regional banks. As a firm, we exclusively invested in financial infrastructure as well as fintech. I worked on the private equity side as well as on the hedge fund side, doing long-short equity trading. I left the firm in May of 2021 to start what is now MJL Capital. And we can talk about sort of that transition and how I got there. However, in short, MJL Capital, like you said, is a multi-strategy hedge fund. We have two sides of the business. The first side is the MJL Digital Equity Fund, which is an early stage liquid token fund. The vast majority of what we do in the portfolio is liquid in nature. We look for emerging tokens with strong fundamental value propositions, and we underwrite to 1 to 3 year investment horizons. We're very active in everything we invest in. And this is really where we put our best ideas that we find across DeFi. The second side of our business, which I know you, Ryan, are very, you are very, oh my God, what's the word?
Involved in, familiar with?
Oh my God, yes, thank you. Thank you very much. Which I know you're very familiar with is Adapt3r Digital. Adapt3r Digital, for lack of a better word, aids in the tokenization of traditional off-chain credit onto decentralized financial rails. And happy to get further into that as well.
Yeah, would love to actually in a little bit. And I guess so with EJF. So EJF is your last firm that you worked at was predominantly a bank and financial institutional investor. So in community and regional banks, you said fintech infrastructure. I guess actually in some sense the jump to crypto is maybe a logical one, but to others maybe less so. Like, where did you see the parallels in what you were doing on the financial side to, kind of eventually jumping into crypto? I know you looked at credit early on, but where were those parallels for you?
I think it's a big question with a lot of somewhat nuanced answers. When you're a financial services investor, we would invest across the capital structure in both equity and credit, and we'd invest in quite a few different kind of entities within the financial system. Whether it's the large balance sheets that hold customer deposits like a bank that are highly regulated, or the payment networks, really every single aspect of how money flows through the system, we were very, very in the weeds on at all times. Now, when you really think about fintech and what was happening there, I think as I was investing more and more into community banks that were supporting fintech companies, which are known as fintech partner banks, these are community banks that are generally small institutions under 10 billion in assets that are able to, for various regulatory reasons, work with large fintech companies. It became clear that the way the world was headed was towards technology-enabled financial services. And that's something that was somewhat apparent both generationally and in terms of demographics and consumer behavior. Now, what we really started seeing when we were investing in these banks was the banking system, especially smaller banks, turning into what I'll call dumb pipes. So you were already in around the 2008 era seeing a bifurcation between the large banks and the small banks. Regulators, generally speaking, wanted the industry to consolidate, so they had less to regulate. They also wanted banks to take less risk and become utilities. Now, fast forward 15 years to today, and what you've seen with SVB and the backstop of Signature and Silvergate, that's sort of all played out. But the point being, banks have become more and more utility-like over time. The compliance costs have gone up. They've had less and less flexibility, and both the shadow banking sector and the fintech sector have really filled in and moved to upgrade and innovate in that system. Now, when we were spending more time investing on the fintech layer, it didn't take a long time to realize that a lot of these fintech solutions were simply putting a cute interface on top of the same moving parts, if that makes sense. So when you think about something like Venmo, when I send you a Venmo transaction and Marcus sends Ryan $50 and you get a notification on your phone, it might feel like you received $50, but when you go to withdraw it and actually access that money, a wire has to clear. It's going to take 3 to 5 days. If you want to withdraw it instantly, they're going to make you something that looks like a microloan, depending on the regulatory structure of the company. So I think fintech was really good at making it feel like things were innovating, but it was really just putting band-aids on top of the same antiquated system. And I knew from being within these boardrooms at these small banks that were powering, the Squares of the world, these elite Silicon Valley VC-backed companies, they were all being restricted by what the small bank in Illinois or Iowa or Nebraska was willing to innovate in their own mainframe on-prem, right? And when you think about it that way, you see that there's quite a bit of constraint on the innovation within the banking system. You could argue that the banking system is 30 or 40 years behind, depending on where you're looking. So when I learned about DeFi, I had been involved in crypto for quite a while, starting in 2016, 2017. When I started looking at DeFi, I think I saw something different than what a lot of other people saw. One of the first protocols I think I really went deep into was Aave and Compound. And when I looked at Aave, the first thing I sort of saw was a balance sheet that looked a whole lot like a cooperatively owned bank. And at that point in time, it seemed like this was the first moment I had seen technological innovation in the capital structure itself and in the underlying infra itself, rather than the interface that people interacted with. Does that make sense?
Yeah, absolutely. And I think looking at kind of this, I don't know what you want to call it. I think, I know you had put together a report and you kind of call this banking 2.0 or just really the last wave of fintech. And, you look at the kind of smaller banks that did well in that time. So like a Cross River, I think is a good example, or MVB, yep. I think also powered a lot of these fintechs. It feels like both of those institutions, so whether it's the community and regional bank or the fintech itself, it almost feels like neither one of them was maybe capturing the most amount of value, where it feels like with some of the neobanks and stuff, they were just a nice Silicon Valley wrapper on top of these banks, right? Just doing the core functions of a bank.
Yep.
And then at the same time, if they ever do get big enough, like a Square, they wind up, getting their own banking license. I think SoFi is kind of in that bucket today as well as a public company. Yep. But I look at something like a Chime that raised, at one point at a $45 billion valuation, I think in 2021. I have no idea where something like that sits today. Klarna comes to mind. Also, I think at peak was valued at 45 billion, raised a down round at 6.7. Different business, of course, in lending, but I guess many kind of examples of that where, yes, the bank was getting deposits, but ultimately the fintech, if it did well enough, was going to grow out of that bank anyway. So they had this weird synergistic but also parasitic relationship to each other to some extent.
I think you really hit the nail on the head there, because that's like exactly what I would see in these small banks is they're so excited to partner and both sides need each other, but both sides, exactly like you said, it's synergistic but it's parasitic. The fintech at the end of the day pushes over and over again until ultimately they have full control of the entire stack, and the bank has an equal and opposite sort of reflex in this whole partnership. And I think to a degree, it's a function of markets, right? When rates are as low as they were, for one, banks become an ultra efficient investment vehicle in that the deposit cost and the cost of capital in a bank, many of the smaller banks we looked at, and even if you look at the big banks, even more so, what did they pay on deposits 5-6 years ago? They probably paid 3 basis points, 0.03%. Some wise man once told me that if you have a cost of capital of 0, you can take over the world, right? So to a certain degree, uh, I think wrapping that business model into something with a higher equity multiple because it's growing faster, because it's the new hot thing, i.e. a fintech interface, makes all the sense in the world. And I think it's just a matter of the market as a weighing machine, understanding what the various returns on capital profile over time can be. And the reason I say that, when you think about Square or something of that nature, and you construct their income statement and you think about their customer, what fees can they actually extract over time? And when you start thinking about,
Right.
interchange and lending, but ceding part to a bank, payments, but ceding part to a bank, the economics generally aren't a whole lot better, um, unless you can completely use and warehouse all of your assets in the bank, and the bank can use its balance sheet. Or said a different way, unless you can make it completely capital light. But the issue is, if you're going to make things capital light and you're going to syndicate loans in real time via tech to a network of banks, like something like a Green Sky, that works until it doesn't, because now you are no longer in control of the flow of capital. So I think there's this, I don't know if it's a trilemma, but at least a dilemma between fintechs and banks.
Yeah, actually, I saw just today that Goldman Sachs is actually offloading Green Sky to some private equity investors. But so something you said earlier that caught my attention was, you said when you looked at Compound and Aave, that one of the things that caught your attention was their innovation in the capital structure. What did you mean by that exactly? I didn't completely follow that point.
I think it's a good question. So, when I look at something like Aave, I think we probably look at the same thing, but with slightly different terminology. I'm trained from looking at banks to think of a balance sheet as, from an asset and liability standpoint, who are the depositors, what do they have to pay the depositors, and what are the loans, right? So a bank will pay the depositors 10 basis points, 0.1%, something of that nature. Now, today it's a little different because rates have gone up. Now they'll lend on a longer term basis for maybe something like 5% loans on commercial real estate. So like the core of their profitability as a bank is that 4.9% or 5% spread between their assets and liabilities. Now, in the current system, pre-crypto, you also have to deal with maintaining all your branches, all of your compliance, which is an increasing cost, all of your staff, really Web 1 or pre-Web 1 distribution systems. And that's really where a lot of community banks are today. That might cost 2% of your assets. So you're going to make 5 on one side, you're going to pay, 0.1 on the other side, and then you're going to lose 2.5% on your expenses. And you're going to ultimately have a return on assets in the 2% range if you're a very profitable and well-run and lean community bank. Now, you're also then just going to go to regulators, or you're going to follow regulations, and you're going to leverage your balance sheet according to a formula that they've given to you. So generally, that 2% on assets that you can make between your assets and liability, maybe you can lever it 5 times, 7 times, something of that nature. Now, when I look at Aave, it's not entirely different. The difference is the model in itself is significantly leaner. So Aave attracts deposits from customers, and maybe they pay 3% to those people depositing to a pool. And maybe that pool will lend into assets on the other side at 4%. Instead of 5 points of spread, maybe they capture 1 point of spread. Maybe they capture half a point of spread. But the point is, there's no humans working there. There are no branches needed. It's always on and accessible to everyone in the world, and it's infinitely scalable. So I think this is something we've talked about a lot offline, Ryan. The difference between a pre-crypto and a post-crypto financial services business. I think a lot of it comes down to taking a much thinner margin over a much larger addressable market and scaling in a way that a community bank simply could not. And I think
Yeah.
the yes.
Oh, sorry. You go. You go.
I was just going to say, just to close it off, the one thing that was always missing for me on Aave is, all right, you have your assets and your liabilities. What's the equity? And pretty early on, Aave introduced staked Aave, which they call it the risk module, but it's no different from a bank to a certain degree. Obviously, the mechanics are different, and it's not highly regulated. But you create a junior tranche, or you create a capital buffer within your balance sheet in case there's a liquidity mismatch. And you can go read the docs of Aave. That's exactly what it is.
Gotcha. Yeah, and by the way, you have a little bit of background noise. Just sounds like touching the mic or something.
Oh,
Uh,
okay, sorry.
but on the Aave point, and I think it kind of applies to the fintech 2.0 point we've been talking about broadly here, which is I'm surprised that kind of having what I think the bankless guys call like uh, what is it? Fintech in the front, the DeFi mullet, DeFi in the back. I'm surprised we haven't
Yeah.
seen more fintech apps that have DeFi under the hood, whether it's providing yield, which admittedly is a bit less appealing today, but providing yield, more services like that, and stripping out, say, traditional just, off-chain functions of yield or whatever it might be. I'm surprised that hasn't taken off more. Unfortunately, I think the apps that got the most users doing that in the past couple of years were using Terra UST, and that obviously didn't end well for those applications. But I still believe that that's kind of an interesting model for some fintech app of the future to follow.
That's a great point. I think that was one of our first core theses when we got into the space. Was I think a lot of people think about crypto and blockchain as something that we're all going to be aware of, and it's going to be everywhere we look when we're dealing with our money. But I think in reality, it's just going to be a much more efficient back and middle office, for lack of a better word. It's going to be something that's abstracted away. It's going to feel familiar. But behind the scenes, it's going to make businesses a lot more efficient. And it's going to ultimately lower the cost of capital over time. Now, I agree. You have not seen that to the degree that I would have hoped. That's for sure. And I thought it's interesting that you brought up UST. That was going to be my example as well. I remember early days in the Luna ecosystem when it first started out. They were actually a more efficient real-time payment settlement layer for e-commerce in South Korea, and that was actually a very interesting business. Now, I think what happened with Luna is almost a good metaphor for the space. It started out there, but then they realized that issuing a stable coin and starting to sort of ponzify, for lack of a better word, the entire business was a lot more profitable. And I think that's something that we've seen over the last year or two is a misalignment incentives between entities that are supposed to be decentralized and their users and stakeholders.
Yeah, and I guess even more broadly on that point of bootstrapping a stablecoin, I think maybe what they realized, because unfortunately, I think what came out in the lawsuits is that a lot of that, alleged consumer transaction volume in Korea was forged. However, I think what they realized is that if you wanted to grow a stablecoin, you needed people to have something to do with it, to maintain the
Yep.
supply. And I think that's where some of the, actually forgetting the name of the app that paid the yield out, but where some of those ideas came from, where they had to pay this 10% or whatever it was. And I think you kind of see that now with new stable coins
Is
like
this
Go trying
Anchor?
to come. Yeah, Anchor, exactly. That was it. And I think now you see with new stable coins like Go coming to market where, yes, Aave naturally feels like a fit to have a stable coin, but there's nothing for users to do with the new stable coin yet. And I think bootstrapping that demand or activities for users essentially is such a challenge for a lot of these products.
I agree. You know, at the end of the day, DeFi and crypto is all about network effects. You've seen it with an asset like Steve with Lido. You've seen it with Dai. You saw it with UST. The assets that do well, whether they can over time or not, the assets that do well tend to be assets that have solve real problems for users, bring them positive unit economics and high returns on their own capital, and assets that are heavily integrated and interoperable. And I think we use those terms a lot, and interoperability almost seems like a buzzword at this point. But the reality is, what is a stable coin? You know, Circle issues a stable coin and they pay nothing on the deposit because they make it so useful for you that you can go make a return higher than a treasury yourself, right? Like to a degree, that's what the business is. And in response, they can leverage their balance sheet under bank regulations ad infinitum, and capture all that yield. So like it really is a good business model when it's done right. The question is around regulatory clarity, and I think the question is around whether incentives are aligned.
Yeah, makes a lot of sense. Okay, so something actually I wasn't planning to ask you about, but since we talked about it earlier, I'm curious. Uh, you've got this background in community and regional bank investing. It seems like that sector of the banking industry has been very troubled over the last year and a half at this point.
Correct. Yep.
I'm sure you still track it pretty closely. What's the state of community and regional banking? Are deposits fleeing generally? Are they all kind of in tough financial situations now? What does that sector look like?
Believe it or not, Ryan, I have not kept up with the community banks, that very exciting sector. I've not been keeping up with it as much as I should. With that being said, you did see generally people clear out from a deposit standpoint around the Silvergate SVB drama. I saw that start to mediate in the quarters after in the Fed's H8 data. I haven't checked it since. But I think the thing I would call out is it was already very hard to be a community bank before. And that was always the heart of our investment thesis, is that the number of banks over time are always going to go down in the US. There's 5,000 of them. It's very difficult to run a bank. It's becoming less and less profitable when you think about the math we went through before, where like, what is the cost of running the business? What can you get on your assets? What do you have to pay on your liabilities? When you apply that same framework today, all of a sudden the deposit yields or the deposit costs you're paying people are significantly higher. And when you look at the yield curve, a commercial real estate loan or something that would be bread and butter for community bank, it's both not attractive from a yield standpoint and not attractive from a credit standpoint at this point in time. So, when rates were at their lowest, I definitely observed a lot of community banks reaching. And to give you an example, a typical commercial real estate loan in pre-COVID, probably when rates were almost zero, was probably a 5-year loan, and they were probably going to get 5.5% on that yield. Now, it got to a point where banks had to compete. They wanted to grow. They didn't want to shrink. And credit wasn't growing as quickly as they wanted. And they were starting to make loans at 10-year terms and 3% yields. And when you start thinking about that math, the duration mismatch that you saw just in long treasury bonds with SVB, you always see a lot of people saying the banking system would be insolvent today if they marked it to market, et cetera, et cetera. Not that I think that's going to happen, but I think it's really hard to be a community bank right now, just in the core spread lending business. And to make that worse, compliance costs just continue to go up. So, when I saw the bank term funding program happen, I think it was just another step towards turning banks into utilities. And I don't want to use the word nationalizing the banking system, but at what point do you call a bank being able to make a loan, take on some level of risk, and then hard coding that loan to par, and the government backstopping it? Right. It's almost like the free markets in the banking system isn't really working the way it was intended to at this point. So I think as an investor standpoint, it's hard to justify being in that space. I can say that.
So I guess on net, you said when you were at EJF, you saw that the number of community and regional banks would go down over time.
Always, yes.
What's the broader impact, perhaps, of that on the U.S. banking and financial system if we go to a system with less and less community banks and everyone's just at the GSIBs?
Well, it's a good question. I think that's two questions in one. So U.S. is the only country in the world that has 5,000 banks, and I think there's a lot of reasons for that. One thing to point to was historically, like for example, in Ohio, there's like quite a few banks in that state specifically because a lot of these were regulated state by state, and across the U.S. I can't give you a year on this. It was quite a long time ago. Only single branch banks were allowed, and interstate banks were not allowed as well. So you ended up having every branch was its own bank in its own state. And if you wanted to expand, you had to start a new bank. And ultimately, you had 5,000 communities, small communities that all had their own little bank. Now, over the last 50 plus years, due to it being difficult to being a community bank and due to the government favoring larger banks over smaller banks, and when I say favoring, I mean doing whatever they can to keep them profitable and existent, generally, and not necessarily consciously, but generally making life harder for the small ones. it becomes a ripe environment for the large ones to acquire the small ones for a lot of different reasons. Um, and it's hard to generalize because the GSIBs specifically are not the most profitable section of the banking system, maybe in dollar terms, but not in percent return on capital terms. But once you go below the GSIBs, you generally see the larger the bank gets, the higher the return on equity. The higher the return on equity, the higher their equity value or their stock value, market cap, will trade relative to their book value. And what that creates is a large bank can buy a small bank. The large bank's trading at 1.5 times book, the small bank's trading at 0.8 times book, and they can use their stock, the large bank, to make a transaction accretive, and they can keep doing that over and over again. So there's sort of a lot that goes into it, but generally speaking, I think this is something that small banks are always fighting for their independence, because the second they can't show that there's a glide path to a higher return, they are expected by investors to sell to a larger bank because the economics are so good. I think the regulators are very much okay with this. For them, we've seen it over and over again. Their ability to regulate the system comprehensively and impartially and granularly is very much challenged. And I think if they had it their way, instead of 5,000 banks with three or 4,000 all under a billion in assets or 10 billion in assets, and then 4 over 250 billion in assets, and then you have 500 between 10 billion and 250 billion. I think they would really have 50 banks all mid-size, and that would be the best outcome for them.
Huh, interesting. So I'm bad at mental math. That's what, 1/100th of where we are today in terms of 5,000 banks down to 50?
Something like that.
Yeah, interesting. Huh. Okay, well, we may have lost a lot of people on this conversation with community and regional banks. So let's get back to crypto. Perhaps just the last question to tie some of this together is, so you have explained a bit how the sort of logical transition here from investing in financial institutions to investing in crypto. That said, I imagine that to some extent, the things you're looking for as a fundamental investor are probably very different, where valuation frameworks don't exist in the same type of way. There's less of this idea of profit, and there's tokens maybe comparable but very different than equity. What have you had to relearn as a kind of fundamental investor looking at this space versus financials versus what's maybe carried over as well from your prior career to this one?
That's a very interesting question, Ryan. I think in short, I've had to relearn everything, but at the same time, it's almost all exactly the same. Let me explain what I mean by that. I think if you're a fundamental investor, regardless of asset class, you're generally always thinking about the same factors. What is the return on my capital going to be? And I think when you go into different industries and different asset classes, the way you arrive at that answer is very different and full of different terms, right? So I think when I approached crypto, like I said, I looked at something like an Aave, and I did see a bank balance sheet. And the first thing I did was, where can the return on equity of this business go? And I think you can generally do that for anything in DeFi. Anything in DeFi is generally modelable and generally has cash flows if there's any kind of product market fit. So I think you can do that analysis. What is difficult in this space, especially through a bear market, is understanding what drives price outside of fundamentals. Because you can invest on fundamentals all you want, and I think over the long term, this market, the digital asset market, is going to act like a weighing machine because of just simple financial physics that happen anywhere. But in the short term, there's quite a bit of beta and correlation to the broader space, to Bitcoin, to macro. So it's been an exercise in risk management. It's been an exercise in keeping an open mind and listening to as many opinions and voices as possible, being as connected to the space as possible. And I also think it's a willingness to both understand and have a solid footing in financial, what I call financial physics, just the basic things that are always going to be true about money, but also learning how they might be changing due to these business models. But at the same time, being skeptical of them. So, it's always a struggle. And I think it's meant to be.
Interesting. Got it. Yeah, I mean, I imagine one of the toughest pieces as a fundamental investor would be trying to pick or assign a valuation multiple to some of these things where yes, they may have a cash flow, but the market may have gotten insane and now it's kind of resetting, but is it even resetting to the right place? I imagine that's kind of the, part of the challenge I would see at least.
I 100% agree. And I think a lot of fundamental investors in the space, in response to that, they're heavily, heavily focused on comps and trading relative value. And I think, we do that analysis, but that's never been the way that I invest personally. I like to think more long term. I like to think in absolute terms. And I also think that one of the most powerful things you can find in this space, regardless of valuation, is a protocol that's solving a real problem, has positive unit economics, where you have a much higher certainty that it will survive and sustain itself into the future. And when you really think about those factors and you evaluate a token and or a protocol, I think you'll filter out a whole lot more than you think. It's very difficult to find a business or a protocol that matches or checks those boxes.
Yeah, and I think some of this too is almost inventing new metrics. I remember about a year ago, we were kind of doing a comparison just on the credit sector. And one of the things we looked at was dollar of token incentivization per dollar of TVL in each of these protocols. And, I'm sure that there's kind of like some CAC comparison with traditional companies, but, I think things like that too, and being creative with inventing new metrics are, another way to go about this. Just kind of sniff out
Absolutely.
bullshit.
It's a great example because that's a new metric, quote unquote, that's really grounded in a basic financial principle. Um, these protocols, when we were talking about this, relative to their actual business, were trading at fantastically high multiples. And it actually made a lot of mathematical sense in the short term to incentivize users by diluting your own equity stack. And that's like something you can't really do outside of crypto. Just from like a regulatory perspective and a logistics perspective, imagine if Apple included 1/100th of a share of stock with every iPhone. That couldn't really
Right.
ever happen. Um, but when you're approaching with the framework of what's really happening here, the answers become clear. And whatever you want to call it, or whatever you want the terminology to be, the basic financial physics of equity dilution versus the value of a customer, and weighing those against each other over time, they're always still there.
Yeah, and it's something I think about a lot now too, just from kind of a strategy perspective almost, where I think after the dust settled of 2020, 2021 with token incentivization, very few of those cases led to any kind of sustaining advantage or,
Correct.
true competitive moat. The one counter I have is really Lido, where, I haven't seen this math, but they probably spent upwards of hundreds of millions of dollars worth of token incentives to
Mm-hmm.
maintain their peg on their curve pools, to establish these borrowing markets where wrap staked ETH could be used as collateral on venues like Aave. And I think that has given them a very lasting position within DeFi that other protocols I don't see have been able to do that in the same way, and certainly something I think a lot more about now going forward.
I agree. I think Lido, it remains to be seen what happens there. Obviously, it's a big subject of debate right now. Are they the
Yeah.
victim of their own success? But I think that's a case study in liquidity. Liquidity begets liquidity. And Steth, once it was the most liquid asset and had the most utility, they're almost two sides of the same coin. And they understood that very early on. If they could create that moat, that would be their business model, right? Now, at this point, I haven't checked in on the name recently, but it'll be interesting to see what they do going forward and whether they can sustain that sort of token incentives, especially with competition, and especially if they can't continue gaining market share in Ethereum staking. We'll see. It'll be interesting.
Yeah. Yeah, and I think my understanding is actually that they have now mostly, especially since withdrawals were enabled, they've actually been able to turn off those incentives for the most part at this point, which again is one of these things where that's the place that everybody wants to get to.
Yep.
But I think so many protocols realize that actually once they turn those token incentives off, that, oh man, these users actually didn't love my product in the first place. And
Exactly.
that can be
That's
that
the
can be
moment
painful.
you know. That's the moment you know, right? And I think a lot of founders in the space have trouble with product market fit. Whether they see the number go up and they think that must mean that their product is solving a real problem, but meanwhile, especially when you throw token incentives in the mix, a lot of this is what I would refer to as hot money. That's going to be there when the economics are good, but not when they're not. And when that protocol and that token goes from a financial utility driven value proposition towards just a product utility, whatever the product or protocol is actually doing, that's really what matters in the long run. The rest is just bootstrapping.
Yeah, absolutely. So one of the things you mentioned one of your earlier answers here is just kind of learning from other, fundamental investors as well. I don't get the impression there's a lot of uh, liquid funds doing fundamental investment in crypto today. Uh, am I maybe seeing that incorrectly, or are there other firms that you work with a lot, or admire, or kind of find notable in this space, or are you guys one of a small handful?
Yeah, I would agree. I mean, when we got into the space, it was sort of the hottest thing since sliced bread. I think there were a lot of people, candidly, with similar backgrounds to me that wanted to start a liquid token fund that sort of saw the same thing that I did. Um, with that being said, 2022 was certainly a trial by fire in risk management, in IR, in building a business. And I think it was very tough for the vast majority of funds. And I think the unfortunate thing is um, how tough that was highly indicative of when your fund opened, which I think, some people call that unfair, but like to a degree, that's life. Um, but there are certainly funds out there, whether they're still open or not, that have really led the way and paved the way for us that we've looked up to. I think one that's always come to mind is Arca. What Jeff does over there at Arca is very interesting. I think I was at a conference and I saw him speak, and he might have been one of the first people I saw really talk about the fundamental case for one of these assets, and I was blown away. And I think it's interesting. I think we speak the same language because he has a very similar background. I know he worked in the financial space. I think we actually, my old boss, we worked for the same company at one point in time. Um, but but yeah, I just like the way that they translate the digital asset space and crypto economics into uh, financial concepts that make sense and bring it back to reality.
Yeah, and I guess on that note of being a fundamental investor, uh, across asset classes, really, I mean, are there specific traits of the best fundamental investors that you try to emulate in either your own investing practice or in building the firm more generally?
It's a good question. I think my answer might not be what you expect. I think some of the things I've learned, um, you know, there's two sides of it. My portfolio manager once said to me something that has always stuck to me. Um, you can spend 30 years building a track record, and it can take you 6 months to ruin it. And I think that the best money managers in the world, no matter how they started out, very many of them started out and their returns weren't great. But once that happened, generally speaking, they go on a 30-year run where they just generally don't lose a lot of money, right? And I think people tend to look at the up years, but it's the down years that define you. One other thing I think that comes to mind is having an open mind. I think depending on where you are and where you're sitting and whether it's on Wall Street, whether it's in crypto, wherever you're investing, I think you have to always like tout this balance between being on your own island and thinking for yourself, but also listening to other people, especially when their opinion differs from yours. I think that takes a lot of discipline um, to do it right. And I think that's something that's very valuable as a fundamental investor.
Interesting. Great answer. So moving on a bit from the discussion on your background and community banks, I'd like to talk about some of the themes that you see in the market today. One that I think is super relevant across narratives right now that you spend a lot of time on, and is actually how we kind of first originally met, is on-chain credit slash real-world assets.
Yes.
So I guess for listeners, so you and I first met back in, I think, October 2021 through a BTIG conference
Yes.
that one of the banks put together. And, you had a lot of great questions about TrueFi at the time. And so I guess as far back as I've known you, you've been interested in and had thesis around on-chain credit and real-world assets.
Yep.
Going back to when I think that was much earlier. Since October 2021, we've seen tremendous growth, decline, and now really like probably peak of interest into the space. So thinking about your original thesis with respect to on-chain credit and what's actually played out, where have you kind of been right versus what's diverged from maybe how you thought things would originally go?
So I think if I remember the conversation correctly, and please correct me if I'm off here because it's been a little while. I think the original thesis in on-chain credit was just that the securitization process and the syndication process, which is really at the core of the lending market in the United States and thus globally, is highly inefficient. Whether I'm settling a securitized product, I'm underwriting it, I'm structuring it, I'm paying lawyers to put together a 500-page prospectus. All of these are manual processes that are significantly outdated. And a blockchain inherently rolls all of these functions, rolls out all these functions from the start, right? So today, I would say, generally speaking, that concept has not changed. With that being said, I feel like it hasn't proven itself out largely from a regulatory and compliance perspective. Now, obviously, there's market volatility, and what happened in 2022 is not helping reputationally larger banks get involved in this space. But it's difficult today because you can go and you could save a lot of money by doing these deals on the blockchain. However, from a compliance perspective, you still end up having to need a transfer agent and all the things you needed before. So like the few tokenized deals you've seen, especially with Mike Cagney over at Provenance and Figure, they're very well done and they're very impressive, but it doesn't feel like there's actually any cost savings happening under the hood. Does that make sense?
Yeah, it makes complete sense. And it is something that at least today bugs me a lot, actually.
Yes.
Where, obviously you have a portfolio on TrueFi. You're, have a fund that buys T-bills on investors' behalf on chain. I think, you can tell me, but I don't know if you would describe the process of setting that up, having a custodian, all the kind of steps involved as cost savings. And I think some of that is the eternal crypto yet, where at some point those cost savings could exist, but
Yep.
at least for right now, that certainly is not the case.
I would 100% agree. I don't think it's definitely has not been cheaper or easier or faster to set up the fund. But I would say,
Yeah.
What is exciting and what is innovative about it is what can you do with your interest in the fund, right? And that's something like that we're always thinking about, and you always want to be careful with. But with that being said, I think whereas hosting these functions on the blockchain and in the digital asset space might not be more efficient from a cost perspective, it could potentially unlock, an arena of programmability, and I think that can be a very powerful thing.
Right. And I guess just to even caveat my own prior answer a bit, I think the formation of bringing assets on chain for the first time can be very expensive, certainly more expensive than it would be just launching a fund off chain. The thing that I guess I'm not positive of, but maybe everything in, after the initial launch of the fund is less expensive.
Yes.
In theory, the fundraising process, in theory, the cost of capital, possibly, I think would at least be some other platforms' stances. Deployment, repayment, all of the accounting happens automatically on chain. Maybe some of that is less expensive. But I've never actually seen a very concrete case study of that done. I'd actually be very curious to read that if someone's done it.
I think I know a lot of ink has been spilled on this topic, and we've talked about it quite a bit, Ryan. I think today where it stands is as an investor, functions are being unlocked. As an issuer, it's not necessarily there. And I've always gone, in the on-chain credit space. My framework has always been, what does each side of the equation not have that it now can? And it feels like, and this is more so emerging, and we've seen it here and there, but it's not as widespread as we'd both like it to be. But large off-chain entities could potentially get a deal done with attractive economics, subscale, because there are efficiencies if they're already set up. Now, when does that happen? I'm not sure. Today, it feels like most of the growth and activity you've seen in the space are on-chain actors able to access off-chain products that they otherwise couldn't in a more frictionless way. And I think we can say a lot about that, but that's the framework I use. And what everyone is waiting for is the former, and what we have right now is the latter. At some point in time, I think they'll be synergistic in some way. Two sides of the same coin almost. But today, that is not the case.
Yeah, and when I do look at I guess you could say kind of two use cases, I think, that are defining of RWA. It was what TrueFi and Maple did, lending to crypto trading firms, which was mostly on-chain actors lending to on-chain actors, right? People who are very comfortable using Etherscan directly. So, there was no additional cost for Wintermute to borrow from TrueFi than there was, prior to, there was no net new cost on them really. And now I think with T-bills, we see, I suppose, something kind of similar where it's on-chain actors, but lending to or investing in off-chain assets now, which is something new and different. And one of the things I think about actually is this kind of framework of what RWAs make sense. And I actually think it's something to do with kind of like a fungibility spectrum, where something like USDC is obviously successful. And one USDC equals one USDC equals one USDC. That's mostly true for something like a T-bill as well. It wasn't exactly true for lending to crypto trading firms, but I don't know, that worked for whatever reason. Then I look at things more like some of the one-off, emerging market credit is obviously a sector a lot of people look at, type of deals, and those just seem so much tougher to me because there's so much individual underwriting that has to happen on a deal-by-deal basis, as compared to, okay, this is a T-bill from a BlackRock ETF or direct purchase from somebody. I think there's something there that's maybe overlooked just in terms of what assets are primed for this right now.
I agree, and it's tough because it's hard to roadmap. I guess it's hard to roadmap logically or ahead of time exactly where the space is going to go next. Because at the end of the day, what is the most powerful thing that crypto has? It's frictionless flows of capital. And in the debt and credit markets, generally speaking, and you've definitely seen this on chain, down the risk curve in the Goldfinches of the world, the centrifuges, the credits, whatever it is, the market makers with TrueFi and Maple, it's going to be the most effective and add the most value when capital is dried up off chain. When there are no other lenders there, crypto can lend, and there is a dearth of liquidity, and it's something that can always sort of fill the gaps. And that's no different from any other system. It's no different from shadow banking post '08, when the banks stopped lending to a wide sort of subsector of finance and small business. You started to see On Deck, Lending Club, all these non-bank lenders emerge. Crypto in itself, as one giant artifice, is its own non-bank lender that's self-funded. And I think that in itself is what makes it interesting.
Well, I guess my question there is that a good or proper role for crypto to play if ultimately these things do still require underwriting. I'm not an expert on things like on deck and such, but I think most of those are pretty challenged businesses today, to say the least.
Yes.
So, eh, where does crypto fit into that? Does it wind up following the same path? What's different? Tell me more about that.
Well, thus far, it's followed a similar path, right? When you look at, I won't say names this time, but a lot of these pools in the private credit space on chain have started to default the last few years. And I think when you're building in crypto and you're building in tech, moving fast and breaking things is difficult, right? Especially when you're dealing with other people's money. Like you said, there's an issue with fungibility. Not every emerging market credit pool, not every borrower in South America or every originator in Eastern Africa, they're not all the same. And when you treat them the same and you structure them the same, you're not going to generally get a good outcome. Now, I do think there is an opportunity here for crypto or DeFi, whatever terminology you want to use, in that, like, what is the secret? What is the thing that DeFi could enable and blockchain could enable? Reducing counterparty risk through transparency and liquidity. And I think if you focus on those two aspects of this, you'll notice that that's where product market fit has happened. And I think when you see a lot of people that are maybe saying that, but take the market maker loans, for example. Do we feel like we really had any transparency into their balance sheet and what was going on? No, obviously we didn't. You think about the emerging market loans that have blown up. Was there really any transparency or liquidity for your interest in those products? No, there wasn't. And that's where things go wrong. So I think that's the problem. But like most things, that's also the opportunity.
Yeah, and that was actually kind of segues well and actually maybe answers what was going to be my next question, which is, I think you're a keen observer of the space. You're a participant in this credit and RWA space. Broadly speaking, I mean, what do you think that some of the protocols or teams are doing right today versus has room for improvement, to be polite?
It's a good question. I think it's hard to generalize. That would be a very easily generalizable answer 2 years ago. But a lot of the teams that were making those mistakes have either been cleared out or have pivoted and sort of woken up to reality. Today, after almost 2 years in one of the deepest bear markets and reputational sort of black eyes that the industry has faced, I think a lot of people have been humbled and they've gotten back to building things that matter and building things that help people solve problems. And I think as long as you're doing that, you're heading in the right direction. I don't see massive amounts of capital being raised and spent for the sake of spending and scaling for the sake of scaling. I think people are generally being a lot more thoughtful. We talked about token incentives earlier in this pod, and ever since we had that conversation, I've noticed across a lot of protocols that behavior has certainly slowed down. And I think another thing that was hurting the space, and this is less team based, but well, I guess it is. It's team and capital structure or capital stack based. You're seeing less deals and less protocols with massive venture capital and early investor unlocks. When you look at 2022, the latter half of 2021 and 2022, as an industry, the fully diluted market cap relative to the circulating market cap, if you strip out Bitcoin and Ethereum and you just look at all the what I would consider the startups and what some people call altcoins, but the token space, that peaked. And I think now that we're in 2023, from a market technical perspective, we're much better. There's a much better setup for these assets to appreciate in value, just from a market and structure perspective. Now, in terms of the teams, I think one thing that I would like to see more of in this space is more risk taking on ideas. And what I mean by that is you see a lot of teams making incremental changes to something that's already happened. And when you zoom out, you got to ask yourself, how many real innovations have happened in this space? The concept of an AMM, that was an innovation. Even the BIS, Bank of International Settlements, will tell you that it's potentially far more efficient with deeper liquidity to run global FX flows through something that looks like an AMM. So that's something that's actually new. A collateralized debt position. That's not something that's new, but the way it mechanically works with a smart contract is innovative. And when you start thinking about things in terms of primitives, there aren't as many primitives as I like emerging that are truly innovative, a stepwise function from what we saw last year. Maybe you see something like, oh, now we have GameFi or gambling fi or social fi. But at the end of the day, so many of them end up just being a different iteration of the same thing. I think what we're always looking for is something that's really different and new. And that's very difficult to find.
Yeah, absolutely. And I think, maybe as it relates to RWA and credit, obviously you've got a company in the space in Adapter, and I guess I wonder, where can you really innovate within RWA and credit? Specifically, if you have a lot of still the same kind of legal restrictions around things like transfers. And I think that's certainly the thing I've seen being in this space now for some time, which is, you're still limited by some of those off-chain legal restrictions that I think can be a hindrance to some of this innovation.
I agree, and when you have to be careful here. But when I look at the on-chain credit space, a lot of the activity that I see and a lot of the returns, in a lot of ways, even down to the structure and the way these things are put together, it's a regulatory arbitrage. And I think when we approach the space, we actually want to be solving problems and playing within the guidelines and giving people a product that's simple and it's clean and hopefully allows them to do something that they couldn't do yesterday with a typical treasury bill. So I think there's a lot of in the pipeline for us on that side of things. But I think where it gets exciting is when you can compliantly and globally offer something that is uniquely only available on the blockchain. I know that's unbelievably general and abstract, but it's the truth.
Yeah, understood. So maybe to wrap up the section a bit on credit and RWA, two questions. One, I realize we kind of haven't really introduced Adapt3r Digital as much as we've talked about MJL generally.
Yep.
Maybe it'd be useful just for the audience to give an overview of Adapt3r and what you guys are looking to accomplish there.
Yeah, absolutely. So we started Adapt3r Digital just over a year ago. And as you know, we did it in close partnership with the team behind TrueFi, both Archblock and Wallfacer, who we would consider strategic partners. We saw an opportunity to tokenize assets in a way kind of similar to the conversation we're having that is compliant and can create real tangible value for financial institutions and innovate on chain. I think one thing, the holy grail that we're always looking to do is to lower the cost of capital for large issuers of credit and financial institutions. And one of the first things, and something that is always going to be in the pipeline, is in the bank space. When we started this, we saw an opportunity to enable banks to participate loans between each other in a much more efficient way that's way more open. And as a result, the economics of their balance sheet and their return on equity would be amplified. To them, that would be a no-brainer, right? And kind of back to our conversation before, you have to be opportunistic in when you do something like that. But really, the point of Adapt3r Digital is to be an institutional bridge for financial institutions that are not crypto native to be able to unlock liquidity and returns embedded in their balance sheet that are right now constrained due to the mechanics of off-chain financials.
Got it. And maybe just in terms of kind of talking about the products a bit. So, today you have a live T-bill fund live on TrueFi.
Yes.
And I know you guys want to do other stuff in the future. Maybe I'll ask you a ridiculous question because, if there was a clear answer, you'd be doing it, or maybe you don't want to share. But do you have a sense of what the next kind of logical products are for someone like Adapt3r to bring on chain, or really anyone more generally, if you want to?
Yeah, absolutely. This is always something we're thinking about, obviously. A treasury fund or a tokenized treasury bill is certainly not the end all be all of Adapter. Quite the contrary, it's just the start. And the way we see it is capital formation in the RWA space is fundamentally challenged. Forget treasuries, think about the emerging market credit, the private credit,
Totally,
all of
totally.
these deals that everyone wants to get done. You can call up anyone in the RWA space from any chain, and they'll tell you capital formation is really hard. Now, what's happening with tokenized treasuries is it's becoming a pretty powerful tool for forming capital, not dissimilar from stablecoins. The primary difference being with stablecoins, a centralized issuer would capture all of that value. So we see our business heading in a direction whereby tokenized treasuries can be a tool to build a larger pot of liquidity and form larger pots of capital that can ultimately be redirected if a user elects towards higher yielding down the risk spectrum opportunities. And I think something that this space sorely needs is, we're not going to take the position of an underwriter, but we really just want to bring good quality assets because that's something that's few and far between thus far.
Yeah, makes a ton of sense. And I guess related to that is, so obviously you are, Adapter is a new issuer bringing assets on chain in some sense, right? It's a new firm.
Yep.
And I see kind of this back and forth in RWA sometimes where there's a lot of new issuers, new firms that see this opportunity and create a new company essentially to do something within on-chain assets. At the same time, you have these, what to me are kind of like pilots, but I guess are becoming more legitimate. But things like JP Morgan or Standard Charter or these large banks that are quote unquote tokenizing things. I guess long term, where do you see that divide between some of like these giant bank led projects where they're taking a piece of their existing flow and quote unquote tokenizing it, often on some kind of private blockchain, versus RWA actually being able to embrace some of the open nature of crypto, maybe with new issuers, maybe with existing large firms? I rambled a bit, but if you get the question, where do you see that
No, I
to that?
totally understand. And it's hard to come to a simple answer to that. I think the framework that we've always used to think about the future in the space still stands today. It feels like the bifurcation, the two different worlds between large traditional institutions and decentralized finance. I don't think that wall is moving anytime soon. I don't think J.P. Morgan and Goldman Sachs have anything to gain by opening up their permission chains to the wild west of DeFi. The money isn't big enough. You think about the size of the securitizations that happen off chain. They could never get a deal done if they could only rely on people in DeFi. They couldn't even fill out one tranche in the deal. So I think for them, it's right now highly focused on operational efficiency, kind of like we were saying before. And I think what you're starting to see now is a lot of these larger firms are figuring that out, and these pilots actually seem to be less so marketing maneuvers like they were a couple of years ago, and now they're actual pilots because it's working better. I remember 2 or 3 years ago, kind of when I was coming into the space and opening MJL, JP Morgan was paying upwards of $1 million for Ethereum developers, which is an interesting concept. Some of these banks are a lot more innovative than people give them credit for. Bank of America, I believe, actually holds more technological patents than any company on earth, or at least in the United States. So I think they're going to continue innovating. They have massive balance sheets, they have massive resources, but they're ultimately targeting very different issues. I think part of the secret to DeFi here is that a lot of capital in the world is held captive. Think about how many people can invest in venture. Only the most wealthy, sophisticated people. Think about trends in fractionalization that are happening pre-blockchain. They all kind of have the same theme. The financial system and capital flows more efficiently and at a lower cost when you increase the access to it. Now, I think regulation is something that needs to move forward, but I do believe that it's going to stay bifurcated at least for the time being. And both ecosystems very well could thrive, because it's not like we've gotten to 130 billion in stablecoins out in DeFi with help from JP Morgan, right? Um, the growth is going to continue, and I don't think we've needed them thus far. I don't think we will in the future. I think there's quite a bit of demand for what's being built in DeFi.
Yeah, and I guess that's kind of something people have always gone back and forth on, which is, do we need the institutions to come in to not even legitimize the space at this point, but just to be such a large source of capital versus have this kind of parallel system that has new and different types of capital sources and whatever that may be. But
Yeah, exactly. I mean, what I always think of is, could JP Morgan fork this? What if JP Morgan forked
mhm.
Aave and just injected the supply of all their own balance sheet, right? Like, it's hard to imagine that the worlds will collide, and you're still going to have something that resembles DeFi. Probably not. Thus, there will probably also always be that other system. And I think that's for good reason. I think when you look at what's happening in the world today from a macroeconomic standpoint, moving from a dollar-based financial system to a neutral, stateless, borderless, currency-based financial system that works programmatically without having to trust anyone, uh, it's one of those things that seems abstract when you first come into the space, but the more time you spend in it, both in the actual banking system, investing in financial companies, and also watching this space develop, uh, it it's something that becomes more and more clear.
Great explanation. Well, maybe just as we're kind of thinking about wrapping up here, something that I'd love to uh, try, if you're open to it, is walk through one or two almost kind of like case studies of some investments you've made on the MJL side, and really just understand the whole process of identifying an interesting asset, how you go about diligencing it, and then ultimately making the investment decision, and just that whole flow of what that looks like.
Yeah.
Obviously, not financial, legal, tax advice, all the disclaimers, yada yada.
Yes. This is not financial or legal or tax advice. Thank you, Ryan. Do your own
Yes,
research, etc. Happy to go through a couple case studies, and I can kind of start. That's a good segue, because I can start from the most traditional side of the spectrum. So
sure.
one of the first names, I mentioned Aave was one of the first names that I'd spent a lot of time on in the space. I think the second or third name was Nexus Mutual. And for those listening, Nexus Mutual is an insurance company. Actually, it's a regulated insurance company in the UK. And what they did was they created what was effectively a decentralized, you could say, crowd-funded capital structure. I think people in crypto would say uh, Ethereum-based capital structure. Pretty much what could happen was, me as a user, I can KYC to fulfill the regulatory requirement. I can purchase an XM token. And in that transaction, I am giving the mutual Ethereum, and they're printing me a token called NXM. That NXM is backed by the Ethereum that I just gave them, right? Generally, they sell those interests at a discount to book, or at least at book value, up to a premium of book value of around 1.6 times book. So this system is starting to change, but nonetheless, they bootstrapped an insurance company. And when I started looking at it, you had a $300 or $400 million capital pool. It was all Ethereum, and they were exclusively insuring Ethereum-based risks. To be exact, or to be more precise, they were insuring smart contract risk. This was something that resonated with me, because in my past life, we were looking at standing up a what was effectively a yield vehicle based in stable coins. I think a lot of institutional investors and credit shops at the time were thinking about that. And the issue you always faced was, it's sort of the unknown unknown. I used to call it the stability put. How do you know that the entire space isn't going to go to zero? Or how do you know you're not going to be hacked? How are you going to hedge all of these novel risks? And what Nexus Mutual would do was, on a completely unlevered basis, insure against hacks, glitches, and smart contract risk, which is probably the most acute risk faced by institutional investors or anyone putting real money to work in, at that time, what were high risk yield farms that were popping up left and right. Now, I saw product, I saw fit. It was growing. It was growing very, very quickly. So what happened with Nexus Mutual was, without going too far into it, was there was a disconnect or a mismatch between the capital flowing into the balance sheet, i.e. people wanting to buy the token for speculation reasons, kind of pro-cyclical reasons, and what the balance sheet was going to be used for, which was ensuring real risks. They were also doing it on an unlevered basis that was somewhat not profitable. And they were also ensuring a risk where there was very little data and the risks weren't very granular, if that makes sense. So it's hard to price that balance sheet. Now, when this must have been early to mid 2021, when the market, when was that? It had to be May to June 2021. What happened was they had to gate redemptions because that mismatch manifested itself, metastasized, so to speak, and all of a sudden there was a rush to sell NXM token. The mutual couldn't have this because they were insuring risks that had some level of duration to them. So they had to not allow people to leave the mutual. They couldn't swap from NXM back to ETH. So what the community did, in a truly permissionless, DeFi spirited way, they created wrapped NXM. So you could deposit Nexus Mutual, which had controls around it for regulatory reasons. It was non-transferable. You could wrap it into WNXM, and that was freely tradable. That was the asset that was liquid, right? And in crypto, just kind of going back to the conversation, price is a function of liquidity more often than it's a function of value. And what we saw was a race to the exits, as you would expect. And if you were to buy wrapped Nexus Mutual token, you would be buying it at something like at one point, a 75% discount to the Ethereum that backed the NXM token, the unwrapped NXM token. Now, the question was, if you were to buy that claim, which is really what it was, at a 70 or 80% discount, how can you be sure that you're going to be made whole at all? And how can you be made sure that you be made whole in a timely sort of manner? So we started doing work. We actually met Hugh and the team at the same institutional conference I met you at, Ryan. I don't know if I told you that, BTIG. And it was sort of a matter of happenstance because I was already looking at it. And we started talking to the team and having the same conversations we would have with an insurance company or a bank in my past life. Let's look at your balance sheet, your capital structure. Let's look how to optimize this and create a structure that is far more efficient for everyone involved. And the answer there was sort of twofold. It was buy back the most accretive use of your capital today is not writing another insurance policy. It's buying back your own stock at a massive discount. The payback that you're going to get on that purchase is going to be far more creative than anything else you can do today, including an acquisition, you name it. You can acquire yourself at an 80% discount. Ethereum is a relatively uncorrelated asset to the idiosyncrasies of your business. It's an absolute no-brainer. So that was something that took a bit of time to socialize. And I think after a while, we weren't the only ones. Lucky for us, Hugh and the team are very sophisticated. And they, even off the first conversation, they understood everything. This started probably closer to a year of conversation deep in the community around this capital action, the feasibility of it, the mechanics of it, the desire to do it, and the effects. And this really rolled into a larger conversation around a plan for the whole business. Now, fast forward, we successfully socialized this within the DAO, and we accumulated a position over time. That position got larger and larger, and eventually, by the time that Wrap Nexus Mutual traded down to about $8, which was again a 70 or 80% discount to book, this was a pretty large portion of our fund. One thing that's funny in this space is you might underwrite to a 1 or 3 year investment horizon, but things tend to move a whole lot faster. And it only took probably 6 months max You can look at it today. It's now trading at 95% of book value, and this has ended up being one of the strongest assets in DeFi in the latter half of 2022 and 2023. So that was a trade for us. Was very familiar, very understandable. It was something that I think we understood far better than the broader crypto community, given our experience in doing these sort of recapitalizations, because that's really what this was. We were thinking about doing a convertible bond. We had a lot of ideas sort of mixed around. But I think that's something that is very indicative of our process, where while other people are looking at the grayscale ETFs, ETHE or GBTC, they're trading at a discount to their NAV. This was a 70 or 80% discount, and no one was looking. So we were able to be long Ethereum. We had a high level of certainty we'd be taken out at or close to par, a very large margin of safety, and we acted on it. I think that's a pretty good example to start with, although I'm happy to go through more.
Well, that's a great example, and I think is a perfect tie-in to your background, as that certainly looks more like the type of takeout or something you'd find in your past life. I would be curious if you had another example that's maybe more crypto native or less this off-chain structure with mutual fund and all of that.
Yes.
Mutual.
Yes, you can still hear me, right? I just had to switch audio.
Yep, I can hear you.
Great. No, I certainly have more crypto native. I would say that's like a really good example, but it's hard to find things like that in this space.
Right. I was going to say that's so few and far between. Yeah.
Exactly. And some people, it's easier to relate for a lot of people. I think another good example, and this is going back to like a similar period of time. This must have been, I got to look at it, late 2021. We were doing our usual screens. We're reading white papers. We're going through docs. We're looking at trending contracts. And we found a protocol called Convex Finance. And for those that are familiar with Convex Finance, in short, it's a governance aggregation tool for vote escrowed Curve and a boosted rewards program for Curve liquidity providers. And I think the first time I read through it, it was certainly crypto native. We'll put it that way. But what really interested in me was this was probably 12 months after the famous Sushi Swap vampire attack, which I found to be extremely interesting. How you could create a token to almost hostile takeover or create better liquidity terms, and suck capital and liquidity into your own ecosystem. So what Convex was doing was they allowed you as a Curve LP to give them your LP interest, and they would deposit it. Why would you do that? Because the way that the Curve Finance voting and gauge system worked, and if you're not familiar with Curve, generally how like the protocol is structured such that there are very deep pools of stablecoin liquidity. As an LP, you don't have risk of impermanent loss, generally speaking, because these are much more stable assets priced on a more stable curve. But the issue was it created a sort of dilemma. If we're going to have deep pools of liquidity to allow for very stable transactions, the yield on those pools is going to be almost zero. It's going to be 1 or 2%, sometimes even less. Today, it's probably 0.5%, a lot of those pools when you really look at it. So what did they do? Curve created a token. Without going through the whole thing, they created a tokenomic system where if you were willing to lock your Curve token for 4 years at a time, they would actually pay you rewards that can take that 1 or 2% yield up to 10, 15, 20%. Now, the issue, and this is really similar to Lido when you think about it, making something that's illiquid liquid. Similar to how Lido, not everyone has 32 ETH to start a validator, and they sort of democratized that. They democratized Curve staking. And it was really timely at that moment because whales that had gotten early into that ecosystem were really running the show. And Convex was a major disruptive force. You could give Convex your liquidity position. They would aggregate it. They would aggregate all the CRV rewards they hold. They would lock it all for 4 years, and you could have a liquid asset and come in and out of the liquidity pool, even though you're not locked for 4 years on your Curve token position. I know this can be confusing, but that's generally how it works. And I think what fascinated me was A, there was a need for this. B, there was clearly product market fit. It was growing like a weed. This was probably the first 30 or 60 days it was around. It made sense to a degree. You really have to get your head around being comfortable with the Curve ecosystem and tokens, begetting tokens and incentivization. But I think really what stuck out to me was it became a mathematical certainty far, far earlier than the market recognized that Convex was going to be successful and it would be mathematically impossible to dethrone them from this ecosystem. We were saying this 60 days into Convex. So we bought that asset. This was very, very early on in our firm, and we did pretty well because if you pay attention today, Convex is one of the most reputable and powerful protocols in all of DeFi. They are the kingmaker of Curve, and they're not being dethroned. So that's something that is highly crypto native that we were able to identify early just by doing the math and doing the work. And going back to your question before, what makes a fundamental investor great across asset classes? It's really not being smarter than anyone else in the room. It's looking, listening, and doing the work. And that was somewhere where we really had to roll up our sleeves and operate in a space where we were a little more uncomfortable. We had to learn a lot, but once we got to an answer, the answer was obvious, and it was obvious that it was mispriced.
Bit of an in the weeds question, but I'm actually very curious about that point of timing and when you know it is the time to actually make the investment decision. Something like Convex, for example, I imagine that you could have waited, another 30 days, another 60 days, make sure that there's no smart contract risk, blah, 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 blah. What gets you to get over the hump and actually get to that final decision of, yes, today's the day that we buy this asset?
I think it's a good question. What it really comes down to is risk reward asymmetry. I'm not going to quote you a number because it's been long enough that I don't remember it, but I can tell you ballpark. There was a couple numbers that made us very comfortable. One, this asset was going to be completely in control of Curve. So, what was the Curve token's market cap, which at that point was revenue sharing as much as Convex was, and Convex was maybe there was a higher dilution, but from a unit economic perspective as a holder, you're making a whole lot more, and you were going to have equal or greater governance power than all of the Curve tokens combined because they effectively aggregated them all, right? They were and are the kingmaker. So the market cap on Convex was but a fraction of Curve, maybe a tenth, something like that. The other thing we looked at was, and we don't always look at this, but this was a scenario where we looked at price to earnings ratio. We did two things. We looked at what is the earnings as a whole, or we did three things. What are the economics, the unit economics as a holder of Convex? How do I think about the yield on this asset? Secondly, we looked at Convex as a protocol, and we looked at what is the price to earnings or the price to cash flow on what's happening. That was a low single digit number, which you got to be careful with in the space. But at that point, given the growth trajectory, it didn't make any sense. Then we projected it forward. All right, there's a good amount of token dilution. Let's see if that token dilution is creative. It was. And let's look at various scenarios. If the token dilution continues and you have a bearish outcome, what would that mean? If you have a bullish outcome, what would that mean? And the easy answer was the downside was significantly lower than 50% as we saw it on a probability spectrum. Obviously, there's always tail risks. Um, but we felt comfortable with those tail risks. And in the bull case, it was worth 5 to 10 times more. So when you're looking at the world as a fundamental investor, regardless of asset class, if you tell me that my downside is even 50% and my upside is 10x in the middle of a probability distribution, uh, you have to stop and think about that for a second. Because from an asymmetry standpoint, where else in the world can you find something like that? I think that's the spirit of our entire fund. And really, what we do, and you kind of touched on this, Ryan, I think the most powerful thing you can do in the space to increase your odds of success, because a lot of things have 10x outcomes, everything, in a way, in a certain scenario does. It's just how probable and realistic is that scenario, and what can you do to reduce your downside and hedge your risk? And that latter point is the most powerful thing you can do because every dollar you save on the downside could be 10 on the upside.
Beautifully well said. Before we wrap up today, is there anything you want to direct our listeners to, or where can they find you online? How can they get in touch?
Yeah, absolutely. We do have a Twitter account, but I'd recommend going to our website. You can reach out to us at info@mjl.capital, info@adapter.com. You can go to the URLs of our website are adapter.com and mjl.capital. So it's a simple story. You can also hit me up on Telegram. Always happy to meet someone new and hear new good ideas.
Awesome. Well, listeners, I hope that you got to appreciate the type of conversation I have with Marcus very often. Definitely recommend getting in touch if you have a liquid token, a new token, or just want to bounce some ideas around. He's a great partner. Well, thank you everybody for listening. That's all, and see you next time.